Welcome to our banking training program. Today we are going to talk about banking risk. The banking industry faces a significant number of risks, which can be categorized as follows: credit risk, operational risk, market risk, liquidity risk. And the bank precise definition of these risks are important, as they serve as the basis for both the qualitative and quantitative assessment of the risk. And now let's talk about credit risk. First, let's define what is credit risk. Credit risk is the potential that a bank borrowers or counterparty will fail to meet its obligations in accordance with agreed terms. This is the definition of credit risk. And the credit risk is considered to be the single largest factor threatening the soundness of financial institutions. Credit risks arise anytime bank funds are extended, committed, invested, exposed, whether reflected on or off balance sheets. Okay, where can we find credit risk? A credit risk can be found in loans, investment portfolio, overdrafts, letters of credit. Credit risk also can exist in a variety of bank products, activity services, such as derivatives, foreign exchange, cash management services, trade financing. Operational risk. The awareness of operational risk has dramatically increased in recent years due to a number of well-publicized operational risk failures and the decision by the Basel Committee to introduce a capital charge to protect against this form of risk. And now let's define operational risk. The Basel Committee defined operational risk as the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. The definition includes legal risk, but exclude reputational and strategic risk. Type of operational risk. We have 7 types of operational risk: internal fraud, external fraud, employment practices and workplace safety, client, product and business processes, damage to fiscal assets, system failures and business disruption, execution, delivery, process management. And now let's talk about market risk. Market risk is the risk that movement in market prices will adversely affect the value of on or off balance sheet position. Type of market risk: interest rate risk, foreign exchange risk, equity risk, commodities risk. And let's start with the interest rate risk. The interest rate risk is the exposure of bank financial condition to adverse movement in interest rate, and many of on and off balance sheet items generate cash flow that are interest rate driven. For example, loans, deposits, interest rate derivatives, security of deposits. And interest rate risk can be as a result of general market risk or a specific market risk. My dear, changes in interest rate affect a bank earning because it affects the net interest income and other interest sensitive income and the operating expense. And changes in interest rate affect the bank's assets, liabilities, and the off-balance sheet item. Why? Because the present value of a future cash flow change when interest rate changes. Foreign exchange risk. The risk that unanticipated exchange rate fluctuation will adversely impact the value of the bank position. It can occur in both trading and lending activities. Foreign exchange risk arises from a spot foreign exchange position, forward foreign exchange position, a future income or expenses, or any other item representing a profit or loss in the foreign currency. Foreign exchange can also arise when bank makes a cross-border loan denominated in foreign currency. Equity risk can be as a result of general market risk and specific market risk. The general market risk is when you invest in a stock that are more vulnerable to general risk than other. And the specific market risk is associated with the investment in a particular company, which may underperform relative to others. So it's related to the company's specific reason and the specific performance. And unlike the general market risk, the specific market risk can be reduced by diversification. Commodities risk. Commodity is a physical product that is traded on a secondary market, and they are raw or partly refined material that can be classified under some general heading. Grains, for example, wheat, corn, soybean. Soft, for example, coffee, sugar, cacao. Meats, for example, cattle, sheep, cows. Metals, for example, gold, silver, copper. Powers and energy, crude oils and natural gas. Banks that use forward or derivative contract for dealing in commodities face the following risks: basis risk, interest rate risk, forward gap risk. And when dealing in a spot or physical trading of commodities, directional risk is the main consideration. Liquidity risk. Liquidity is the ability to fund increases in assets and meet obligation as they become due. And we have different dimensions to liquidity risk. First, funding liquidity risk, which means the inability of bank to raise fund in the market at a cost equivalent to that of other similar banks. And the second dimension is asset liquidity risk, which means the inability of bank to sell or unwind asset position in the market. The two dimensions of liquidity risk can be closely related. For example, a bank that cannot obtain funds in the market to meet its obligation may have to sell its asset at a lower price or pledging them as a collateral for loans.
My dear, as I always keep saying that learning can always be fun, so try to have fun while you are learning.